Okay, today we are talking about emergency funds, probably the second or third most important piece in a financially stable puzzle. I would say the first most important piece is a strong income. Without a strong income, it's just going to be tough. And a second most important piece is a budget, preferably a written budget, so you know where all your money goes at all times. So the second or third must be an emergency fund. An emergency fund is a big chunk of ready money, money that is ready to be used to pay for unexpected, necessary expenses. And that's a definition of an emergency. Unexpected, necessary expenses. And a final note before we get going. This is yet another example of something that is so financially obvious to everyone who stops and thinks about it just for a little bit of time. Is one of the most obvious things that no one can argue with, that you need money to pay for emergencies, and that will make you help make you financially stable. So obvious, but it's nearly impossible for people to follow through with. I would say that everyone knows this, even if they haven't thought about it, but if they stop for 5 seconds, they know it. But yet, why is it so hard to follow through with? Well, that is a talk in and of itself. But let's just say for right now, it is one of the most obvious financial pieces of truth, and it is, for whatever reason, nearly impossible for people to follow through with. So this is another example that if you want to be financially stable, if that is your goal, then you will be unique. You will not be like the average. You will have to do something that others don't. So I'm not going to make a simple idea more complicated just for making it more complicated. I'm going to try to talk about it and use it to reinforce other concepts that are adjacent and next to the emergency fund itself. Okay, so we're not trying to make the most simple thing. Simple. Have a chunk of money that can take care of your emergencies for whatever life throws at you. Let's not, boom, you're good to go. Go do it. Now we're not making it complicated. We're just exploring this idea. Don't get lost. That first thing, go have a big chunk of money that you've saved up ready for emergencies. Don't let this screw that up, okay? This is just more in depth. So here's your assumed situation where the emergency fund fits into the overall picture. Now, if you can't do this overall picture, okay, I get that. But the emergency, don't let that make you not have an emergency fund, okay? So, but this emergency fund fits into this very nice overall picture. So, first off, all your money is budgeted and controlled. If someone must have said it, if you don't have control of your money, then your money has control of you. Look it up. Someone said it. And if no one said it, then I said it and I win. But no, someone had to have said it. That's too obvious. Let me look it up. Yeah, it's a quote out there. Okay. So here is your assumed situation, right? You got an income, a job income, okay? And if it's a good quality job income, that's what you're shooting for. If it's a very good quality job income, you could just have your job. If it's a good quality or not so good, you're going to need a side job, okay? So you should probably have a couple sources of income anyway. That's probably a very good goal. So you got a good steady income. Now, the first thing you do with your money on a monthly basis is you pay for your necessities. Your food, your shelter, your clothes, your debts that you're repaying, and you should probably be only paying a house mortgage, a small car loan, not a big one, and student debt. Any other debt you shouldn't have, okay? And if you do have it, there's people out there to tell you how to get rid of it. Keep the lights on, your necessities, okay? That's the first thing you do with your money. Then you make sure you have a fully filled emergency fund. Okay, so if you have, let's say you're starting from scratch. The very first month when you have a good job, you pay for your necessities, and if you don't have an emergency fund, you put all your extra money into your emergency fund. You don't go out, you don't have fun, you don't do anything, you don't start a retirement account, you don't start saving, you emergency fund. Okay, that's the very first thing you do when you have your first real job. Pay for your necessities, and then every dollar after that goes into your emergency fund until your emergency fund is filled up. That's why it's a dotted line. Once it's filled up, your normal budget kicks in to play, and you put your money next after you've paid for all your necessities. You put into your retirement account and your savings for a major purchase. Okay? And if you don't have enough money to fill your savings goals or your retirement goals for that month / that year, you don't have fun because you don't make enough. But if you have saved all you want for that month and you have put in for your retirement account that month and you still have extra money, then you get to have fun. This is why people don't have an emergency fund for the vast majority of people, is they skip right to the fun. This is why people don't have retirement accounts. This is why people have trouble saving for major purchases. They get income from their job and immediately they start spending on necessities and fun. And then all of a sudden, there's no more money to put into a retirement account or into a savings account for a house or whatever, for a vacation. So after a couple months, your emergency fund will be filled. A couple months after you have your full real job and getting paid pretty well, your emergency fund will be filled. So what do you do with it? You use your emergency fund for expenses that are unplanned and that are necessary. So your car breaks down. You take from your emergency fund to fix your car. Your water heater breaks. You take from your emergency fund. You fix it. You get sick and you have to do a $15 copay. Well, take it from your emergency fund. $20 copay. Your cat gets sick. That vet business is going to be from your emergency fund. And then the second big use of your emergency fund, which is even more important than that, is you use your emergency fund to fully replace income if your job is lost. I mean, maybe not fully. Replace income if your job is lost. So it is entirely possible, that all of a sudden, boom, job is gone like that. And it's possible you don't get unemployment insurance, so boom, zero income starting now. How do you live? Emergency fund. It should be enough for your necessities. Okay, so the two major questions you have with your emergency fund: how much should you have, and where should you keep it? Okay, so they say 3 months to 1 year of all your necessities. So add up what you need per month, not fun, just what you need, necessities, to survive while still making your debt payments. Okay, add that up for a month, multiply it by 3, multiply it by 6, multiply it by 12. 3 months, 1 year, half a year, 6 months. This is the idea that your income could be able to go down to zero, and you should be able to take care of your whole household's necessities, your part of it, for a certain amount of months until you can get income again. There's a lot of factors, and it's really different for everybody. 3 months to a year. What do you want? A number? 6 months. Go for 6 months. So where do you keep it? It depends how much control and how much knowledge you have over your money. Okay. If you don't really have a lot of control and you don't really have a lot of money, just put it in a savings account. Find a local bank, put it all into one account, and just keep it right there. It's not the financially best thing to do, but it's the easiest. So if you need easy, that's how you do it. Let me talk a little bit more about a more complicated, which, remember, if it's too complicated, just go to easy. You won't need your whole emergency fund. I mean, this thing could be $10,000 to $20,000, okay? You don't need $10,000 to $20,000 when the wheels break on your car, right? You need the full emergency fund when you lose your job, and you know in advance, that you're going to need the $20,000. You only need a little bit immediately. So you break your emergency fund up, okay? You put a couple $100s in a local checking account with a debit card. And so you always have $200, $500 of spendable emergency money instantly. Now, why don't you put all of it there? Because it's not making any interest. It's not making any money, right? But it's there for you immediately. Then you put $1,000 or $2,000 into an online high-interest savings account. Because, what are you sacrificing? You're getting maybe 1% per year, which is not nothing. So your money's working for you, but it's going to take 3 to 5 days to get into your bank. And then you put the rest, the other like $15,000 or something, into the highest interest, safest thing you can get, which is an online certificate of deposit, online CD, like a 5-year CD. Now, this is like a savings account. It's still 3 to 5 days to transfer the money out, but there's a small penalty if you take it out before like 2 or 3 or 5 years. It's not that much of a penalty, so it's definitely worth putting it in. So you see what you got. You got the stuff you're probably never going to use because you're not going to lose your job, but it's there just in case. You got the stuff you use immediately, just a couple $100 for the things that happen just like that. And then if there's like your water heater breaks for $800 and you know you're going to pay within 3 or 5 days, you got it in an online savings account. Now, we're using checking, savings, and CDs for a very specific reason. Number one, they never go down in value. They are always just right along that line. And the CDs just barely go up. They always stay the same value. So whenever you need it, it's there for you. It's never going to go down for a month and up for a month, down for a month. And two, it's guaranteed by the government, okay? So your bank goes out of business, you don't lose your money. It's guaranteed. FDIC insured. Okay, so, I mean, that's it. That's emergency fund. So the rest is just some discussion points. Sometimes questions, sometimes advice on it. Here we go. Do you really need one? Yes. I mean, if you are accumulating wealth, if you want to accumulate any kind of wealth and have any kind of financial stability, you do. It is just, the worst case scenario is you lose your job and then there's no income. You can't get a job and you can lose your house. You can be evicted from your apartment if you rent. I mean, it can throw your whole life, it can throw everything financially into disarray. You just need it for the worst case scenario. People lose their job all the time. I mean, it just happens. And you might say there's unemployment insurance, but you don't know that. Not everyone gets unemployment insurance, okay? You could be fired for cause and you're not getting unemployment insurance. And you would say, well, I would never do anything wrong. You could be accused of doing something wrong and not get unemployment insurance, okay? And straight up, you might think you're very comfortable, but every 8 to 15 years, the U.S. economy goes through a crash. It just happens, and it doesn't hit every sector all the time. Sometimes, so no one's job is 100% safe. It's just, I'm not saying you will lose your job, but the possibility is always there. And if you don't have an emergency fund, how are you going to pay for things? Borrowing puts you into debt. Once people get into, it costs way too much money. And this is the number one thing. Once people get into debt, it keeps them from being financially stable, hitting their retirement and financial goals, okay? Whether it's student loan debt, credit card debt, just personal debt, borrowing for anything. And you get into credit card debt, it gets into a cycle that you can't get out of. That's even if you can borrow money if you lose your job. Also, having an emergency fund takes away a lot of stress. Just the fact that you know that you could have no income and be fine for 6 months keeps a lot of stress out of your life. So a quick note on how to use an emergency fund. This is something a lot of people don't talk about. They say what it is, but they don't tell you how to use it. Here's how to use it. So when you have an emergency, you gotta go to the doctor. Spends $25 copay. Boom, right out of your emergency fund. Your car breaks, $300. Pay for it right out of your emergency fund. Now, your emergency fund is $300 less than it should be. Or $25 for the doctor's visit, less than it should be. Okay, so immediately try to pay back that emergency fund before you do anything else. Stop all your fun spending. Okay, for the next 3 weeks, or for the doctors, don't go out to eat next week. Use that money to fill it into your emergency fund. Okay, don't go out to eat for the full month if it's to pay back that $300 for the car, okay? Stop your fun spending cold until your emergency fund is back to where you wanted it to be, okay? Now, if you ended up having to use $2,000 or $3,000, and, that would take a whole year's worth of fun or whatever. If it was a big emergency, you can stop putting into your retirement account or stop your savings. Like say you were saving for a vacation. Stop your savings for your vacation, stop your fun, put it right back into your emergency fund until it's topped off, okay? So it's basically when this goes down, stop the fun spending to fill it up. If it's not filling up fast enough, stop your savings spending for a house until it's filled up. If it's still not filling up fast enough, stop your retirement account until it's back to where you need it to be. So when you use your emergency fund, it becomes priority 2. Your first priority is always necessities. And then you dump everything into your emergency fund, it'll be right back up. Why can't you do it slower? Because you're just never going to fill it back up. Get it back up as soon as possible because it's there for your emergencies, and then go back to your old spending. Wow, that sounds like you're really following yeah, it's called a budget. You are following where all your money's going. Okay, so you may say, some people say, well, I got this savings account that I'm using to save for a vacation or for a house. Why can't I just use that instead? Why can't I just not have an emergency fund, and then if something goes wrong, just take from my future house savings, my down payment, or my vacation savings? The answer is you could. If you were incredibly disciplined, and it would just be combining your emergency fund. It's just not a good idea. Number one, this thing has got to be really big, your emergency fund. It's got to be 6 months of necessities. So most of the times, just your savings for a vacation fund will not be big enough for a full emergency fund. Secondly, psychologically, it just doesn't work, okay? You'll take from your vacation savings to pay for your car repair, and then you're just not going to put it back in. It's just your vacation savings is now going to be lower, and you'll just be like, nah, I'm just going to go out to eat this month, and you're not putting it back in. Having a separate fund labeled emergency fund gives it gravitas, gives it importance. You know in your mind that that's there to save your butt when poop hits the fan. And so because it's your emergency fund, it is your number one important thing after necessities. So when that is emptied a little, everything in your budget fills it back up. It doesn't, saving for a house and saving for a vacation doesn't have that importance. It doesn't have that sense of urgency. So that's why you don't combine them. You make this something special. You make this something you're proud of. You make this something that you have that no one else has in the United States, and that's what makes you financially secure. You just don't lump it in with your honeymoon savings or whatnot. Are there other ways to cover your butt other than an emergency fund? Yeah. There's 2 other ways you can do it, depending on situation, maybe 3 or 4. Each one is involved. Each one has a little bit of negatives. There's slightly more rewards, but they take more time, and there is some risk involved. So just the emergency fund is the straightforward way that's not going to get you in trouble. So the last question is, why can't I invest it in the stock market or bonds? A stock market or real estate. Stock market, real estate makes what, 6-7% a year? That'd be good to have $20,000 in that. Or bonds that make like 4% a year. That'd be good to have $20,000 in. Why are people keeping the bulk of their emergency funds in savings accounts and certificates of deposits? The highest percentage that's going to get is 2% per year. Why aren't they putting it in something that's 6 or 7? Well, the answer is you could, but it's risky. Yes, I get it. The stock market always goes up over time, but it goes up and down and up and down. If you've got your big $20,000 emergency fund, we're just pulling that out of the air. It could be less, it could be more. If you've got $20,000 emergency fund and you put it in, well, what if you need that full $20,000 over in like literally the next 6 months? If you put your okay, so let's say this is the stock market. It's the S&P 500, but let's just say it's the stock market because it's close enough, right? And if you put in like your emergency fund right here in about 2000, okay? So you put your you built up your $20,000 emergency fund in 2000, but then you needed it in 3 years, you would have to sell and it would be worth less. It would be worth 70%. You'd be losing money on it. Yes, if you put your emergency fund in here and then you didn't need it for 15 years, then that would be good. And if you didn't need your emergency fund for 20 years, that would be excellent. But it's too risky. 2007, if you built up your emergency fund for 20,000 and then you needed it in 2009, it would have lost half its value because you would have had to sell. So when you put it in one of those very low interest CDs, it will go up very, very slowly at 2% a year, but it will always, it can't go down in value unless you take it out. So we're giving up potential growth because we know our emergency fund next year will be worth $20,000 plus a couple. And the year after that, the emergency fund will be worth $20,000 plus a couple dollars. There's no chance in these things. It won't grow. It won't grow hardly at all, but there's no chance it'll go down. And remember, in the stock market, you lose money when you sell down. Stock market's fine as long as you're into it long term. Money put in here, if you didn't sell till here, you're going to make a lot of money. But if you put it in 1 year and then sell the next year, you might go down and might lose value. I hope that explains it. Why we don't put our emergency fund in real estate, in bonds, in stock markets, because they all have the potential to go down for a year or two, and we might need our money then. And so there's the emergency fund, an incredibly simple concept, pretty hard to do in reality to adjust the mindset to do it. And it's got a couple little twists of complexity in it. All right, thanks for watching.